What's going on, Aerial Effects community? I hope you all are doing exceptionally well. Welcome back to another Smart Money Concepts video. And in this video, I'm going to show you the part of my strategy that has made me the most money over my 5 years of trading experience. And the best part about it is that it's so simple to apply. So simple to identify, apply, and a great part about it is that it presents itself day in and day out. I literally have about a 90 to 95% success rate with this particular formation, and I'm going to share with you exactly how I trade it in conjunction with all my other smart money confluences. All right, so before I get into the actual strategy and how we can approach it, I first want you guys to have an understanding of how the markets are moved and the ways in which they are manipulated. So we all should know that every single market across any asset class is manipulated by the central banks. Okay, we as retail traders don't move price. The banks and institutions move price because they have the millions and billions of dollars to do so. We don't have that kind of money. So how do they move price and how do they make their money? Because when we understand how they move price, then we can look at the clues they leave behind to take full advantage of them and take trades alongside the institutions to have the highest probable chance of success. So this is why smart money trading not only produces insane risk to reward, but also at the same time has a high win rate because it's going along with the real way in which the markets actually move instead of all the retail trendline, Fibonacci, pattern nonsense. So for simplistic purposes, to make it as simple as possible, because that's what we're all about here at Aerial Effects, making smart money concepts simple so that anyone can understand it and apply at any point in time. So I'm going to take a look at an area of resistance that is forming right in here with this drawing. Retail is putting their stops above the high because that's what they're told to do. They think that price is not going to come above this resistance level, so they put their stops above the resistance, thinking that if price comes higher, they will be taken out of the market because they think price will continue. Well, the institutions know this, and they can see the order book. They know exactly where your stop losses are, take profits, and your entries. So seeing that, how they take full advantage of retail traders is by attacking their stop losses. So when price pushes up higher here, hits that group of stop losses and moves away, retail traders are probably thinking, well, why did it hit my stop to the T and then continue in the overall direction I was originally trading in? And you guys are probably thinking the same thing. Like, I have seen that so many times in my trading. It's hit my stop loss and reversed immediately. Well, it's because they're attacking your stop loss and a lot of other people's stop losses, because a lot of you trade very similarly in terms of retail patterns and formations and all that good stuff that the institutions take full advantage of. So when you are subject to institutional manipulation, you are going to have that sort of reaction. So you are forced to essentially buy back your position at this particular price. If this is your stop loss, if you're selling in here, when price comes up in to hit that stop loss, you are forced to buy back your position at a higher price, resulting in a loss. So when you are forced to buy back your position through hitting the stop losses, now the institutions have someone to sell it to, right? So if they're selling, they have someone on the other side of the market, aka retail traders, to buy their positions from them. Because when price comes back up, now they are selling in this region. Now they're getting out of their position. How do you get out of sell positions? You have to buy back your position to get out. Now you're doing that at a higher price, which results in that loss. So we already know for every buyer there's a seller, and vice versa, for every seller there's a buyer. So when these institutions push price up to take your stop losses, and you're forced to buy back your position, when a group of traders do that, now there's enough liquidity so that they can sell. They place the majority of their contracts at that price, which causes price to then move sell side. So now it is equal. They're selling to everyone else because you, who are buying back your position due to the loss that you incurred through the stop loss, it now equals their sell. There's a buyer and there's a seller. So when price manipulates its way up, then they can then push price back to the downside. And how we look to enter is simply just off of the mitigation. Because they had to buy price in order to sell it off, because they had to buy it to push up into your stops, when price is down in here, they're in drawdown on their buys. So how do they get out of their position in order to continue into profit? They have to come back up to that same level in which they bought it from to now break even or mitigate to make less severe so they can continue with their overall sells. Once they've mitigated their buys, now they're 0-0 on their buys, they get out of their buys and now into their sells again, in which they're making money from here. Okay, so that is how just the basics of institutional manipulation, liquidity, and volume are introduced into the market. Now, how do we take advantage of that in our everyday trading? Now, the particular pattern that I look for all the time, that presents itself time and time again, is that retail head and shoulders. Now, I don't trade head and shoulders like you may think. I trade it in a way in which I wait for retail liquidity to be purged, a clear reaction from the level, a clear breakout lower, a clear push back in the correct direction, and then a pullback to mitigate orders like the institutions do to mitigate, and then continue with price. So I'm going to show you a ton of examples here across the board. I'm going to show you a couple on EURUSD that we have actually sent to our VIP community, a couple on GBPUSD that we have also sent to our VIP community, and then one on CADJPY that paints a very clear picture of exactly the strategy that we look to trade from. Okay, so let's first start off by talking about EURUSD. And at any time, guys, if you do resonate with this type of strategy, if you think that you can follow along and do this as a career, meaning if you want to do this as a career and you can see yourself trading this way, I highly recommend go visit my website, aerialfxtrading.com, book a free call with me. I give you my full trading plan. I give you my full advice as to how you can go forward in your trading. And I want to make sure that if you were to come on board on my program and use me as a mentor, working with me daily one-on-one, then you will be in the best hands. I want to make sure that this is the right fit for you, which is why we like to just speak with you about your goals to see how we can best help you. If we can, we'd love to extend that invitation. And obviously, if we can't, then we send you on your way with our free trading plan, our free beginners course, and advice going forward on how you can best attack the market. So guys, if you feel that you are resonating with this type of strategy as I'm going through, feel free to book a call. Let's just have a chat. It's completely free. All right, so let's first start off by talking about EURUSD. And I'm going to go to an example that I actually sent to my VIP members back in 2021. This was a while ago. Now, if I zoom all the way out, my setup is in this region of price. Now, what we have to do first and foremost is do our top-down analysis, right? So the pattern that I'm showing you, although it can, in a sense, be applied to pretty much anything at any time, having that holistic understanding and all of the confluences of institutional trading make the pattern that I'm going to show you when it does form much more profitable and much more probable in that sense. Now, the pattern that I'm going to be talking about, like I said, is that head and shoulders fake out. So I'm sure you guys have seen the head and shoulders pattern. It can look like this, or it can look like this. Many different ways it can look, but usually it looks like either of these two. Now, what is retail taught to do when price breaks this neckline? They're taught to sell upon the closure because they think that with head and shoulders, it is a change in direction, right? We push up, we push down, we push higher, we push down, we don't make a higher high, and we make a lower low, and now we're going to pull back to retest and then continue lower. So they either sell upon the closure below the neckline or the break and retest to continue to short. Now, what we simply wait for is the manipulation, because if they're enticing traders to take short positions in here, now the institutions can get in long. Remember, for every buyer, there's a seller. So when we see the fake out, meaning a push below the neckline and then an immediate push back to the upside, breaking counter trend structure or breaking the right shoulder, we now know the institutions are behind this move and we can take advantage through a pullback, mitigation, and continuation. So that is really the four-step approach, is to look for the head and shoulders, wait for the breakout, wait for the reversal and break of structure, and then wait for the pullback to enter. So I'm going to show you a few examples of how we can utilize our entire strategy going from each confluence to each confluence and rule to rule that I have when following institutional formations and concepts to be able to take full advantage of these opportunities and make the most money possible. So let's first start off with the higher time frame because we have to do our top down. So top down can be quite easy if we just know what to look for. Right, where is the current trend? Obviously the setup is forming in here, so obviously we don't know what all of this price is. Okay, so when forming in here, we have to look left. What is price doing to the left? Well, if we just zoom out on the weekly time frame, where are we going? Well, we are bearish. We're making lower lows and lower highs. As we can see, price is pushing down. That's very easy to identify. Now, if we zoom in to this level in here on the weekly time frame, this is a lower high, right? Now we want to see a lower low, but where is our nearest demand within this pullback? And it's very interesting that I say that because, you know, when we have an area of demand that gets invalidated, it will oftentimes turn to supply. Now, this is a demand that if we were going to go long from, we should have reacted from that level and gone long, but instead we went short. We broke out. We have closed below this demand zone and then this structure point. So when this happens, we can see the reaction from the level of demand. And then instead of making a higher high, we have turned around and made a lower low. Naturally, we would be expecting that to begin with because we are in an overall downtrend. But now that demand has failed, because if it didn't fail, it would have made a higher high. But in this case, we made a lower low. The demand then turns into supply. So now we can see the reaction from the demand and mark off that to the right. So when we make a lower low, what do we expect? Lower high. So that's exactly what happens. We come into that exact same level, and on this time frame, we can just see weekly candles consolidating. This is a huge distribution on the lower time frames. Consolidation, and then we have the break to the downside, and we continue to make lower lows and lower highs. So what does that do? That turns this into supply. Okay, so now we know that demand has turned into supply here. We have then reacted from that supply, and as we start moving away from that, that creates the new supply. So we pull back up into that supply level and then have another reaction as expected. So going down to the daily time frame, we can see that clear reaction and we can wait for potential shorting opportunities. So what we have to do is when we're looking for shorting opportunities, we have to ensure that the counter trend is over, right? Because we don't want to continue to trade short when we're still bullish, right? Price could have easily gone like this. It could have pushed deeper into this supply level and then maybe reversed. So we have to wait for the counter trend break of structure, right? So that occurred right here when we broke this prior swing point, because we've had a high, we've had a low, we've had a high, we've had a low, high, low, high. Where was our previous low? Right in here. We had the reaction just like from here, right? This was the reaction to go long from demand that was over to the right or to the left. When we made a higher high, we pull back again into demand to make a higher high. Pull back into demand to try to make a higher high. Oh, we stop and we make a lower low. So now the structure has been shifted. And just like I showed you on the higher time frame on the weekly to the left, we can now say that this demand has turned into supply. This is the last buying volume before we broke structure to the downside, creating the supply level. So you could have waited for the pullback back up into here, and we can clearly see that we didn't make it. We ended up falling again. And when price was trading in here, something started to form. Now these retail head and shoulders or inverse head and shoulders, they form often, but it's not necessary in order to trade. Because like I said, this turned into supply. If price just had to come up into that level, I would have sold it, right? But because of the fact that it didn't, and we still needed to mitigate this level, when price started to form this head and shoulders pattern, I figured that retail was going to be on the opposite side of my trade. And that's exactly what I want them to do. Because when I can see that retail is doing one thing, I try to do the other. Because that's what the institutions do. That's how they make their money, as just described. So we can see the neckline here. This is the neckline. This is the left shoulder. This is the head. And then this is the right shoulder. And we can see the multiple touches here. One touch, two, and a couple touches in here. So price starts to fall from this level, and then we have the breakout. So this will entice retail traders above the neckline of this inverse head and shoulders. Obviously, this is an inverse head and shoulders. This is a regular head and shoulders. Okay, so when price pushes back up, it entices retail traders to take long positions. But we were already looking for shorts from this particular level. So not only did we get in right in here, but retail traders got in right here as well. But who's on the winning side of the market? We are, because we're institutional traders. We are trading alongside these banks. So we are selling, they are buying. So now we have to go to that second part. Remember I told you that they also not only buy above the neckline or below the neckline, whichever direction it's going, but they also wait for the break and retest. So now let's scale in to, I'm going to go to a lower time frame. I'm just going to keep scaling in until I find something. Where is the break and retest? It should be located right in here. Right, this is the break. The retest should be somewhere in here to go long, right? Because they're thinking if it breaks out, it should pull back to go long. And now we look for the counter trend. We can see high, low, high, low, high, low, high, low, high, low. This candle right in here is very important because this was the reaction off of demand that failed to generate a higher high as it should have. Obviously, we already came into our desired level, so we probably knew it wasn't going to. But it failed to make a higher high up here and it made a lower low. So that turns into supply for us, okay? So we can see this inverse head and shoulders fake out that of course failed. Retail lost again. In here, the counter trend, this is demand, we come back down, mitigate it. This is new demand, we come back down, mitigate it. This is new demand, we come back down, mitigate it. This is new demand, we come back down, mitigate it, but we don't make a higher high, we made a lower low. So now this becomes that level of supply for us. However, if we go out to the higher time frame, let's see where the liquidity was influxed to entice retail traders to take certain positions. So the last selling volume is really in here. That's the last selling volume. This was the overall last buying volume that introduced liquidity into the market in order to take retail traders' positions here, enticing them to buy, to then sell it back off and take their stop losses, which are resting below this low, which is why when price comes back down into that low, you can see the reaction from it, natural profit taking from the stop losses that were triggered. Okay, so where do we look to enter? Well, first of all, that 3-hour candle was like right in there, right? Oops, go to that level. That would be our first entry. Actually, the 4-hour would be our first entry. In this case, obviously, it doesn't have to be every time. It just depends on what time frame we're on. But this is our last buying volume. This was the fake out. Buy to sell. Counter trend has been broken to the downside. So that would have been our first pullback into that last buying volume. Beautiful wick entry we would have had. And then obviously, if we came higher, had a deeper pullback, that lower time frame demand that flipped to supply would have went here. And obviously, we did not hit that. Price just ended up rolling back over to the downside. So that's one example of how we can introduce these head and shoulder fake outs into the market because it has exact reasons for the movements. It's a retail pattern in the opposite direction of trend. We are now bearish because we have closed below structure. So why would we be wanting to trade long above the break of this neckline when we're bearish? We've already come up into a higher time frame level and we have reacted from it. So now we're looking to go short. So that's retail traders' mistake number one. Mistake number two is that they're following these head and shoulders patterns that have it has no applicable justification to how the markets actually move and how money is transferred. So when we see the manipulation to the upside, enticing retail traders to buy, we not only mitigate this level of supply, but we also then go attack their stop losses. Now we come back up, mitigate, and then continue, just like the example I showed you at the beginning of this video. So let me get out of bar replay mode here, and I'm going to show you some other examples that have played out relatively soon, like in the near past, I guess we can say. So I'm going to show you some examples in here of exactly how we were able to take full advantage of this exact setup that literally has produced me tens of thousands of dollars, hundreds of thousands of dollars over my 5 years. It is so easy to identify and easy to apply, and it comes down to a streamlined set of rules. It really comes down to four simple steps. Again, look for the head and shoulders, wait for the breakout, then wait for the reversal back in the original direction, the break of structure, and then wait for the pullback to get in. That's simply it. So now let me just go back to the higher time frame. So we got in here short. Okay, so the trend is obviously bearish. We've already identified that. Now we have to understand where our overall objective lies, meaning where are the institutions looking to take price? We can't just sell and just keep selling and selling and selling. Well, when is price most likely to stop selling and go long again? And that is what comes down to objective. So if we go to the higher time frames, the weekly time frame, and look to the left, we can see that we're clearly in a weekly to monthly time frame uptrend. Higher high, higher low. Higher high, higher low. We're potentially, just based upon market structure, making a higher high. That's always a potential. Obviously, fundamentals may come into place. Price could end up pushing back down, but we would naturally expect a higher high and a higher low formation. Okay, so we have to look at areas of demand to the left that price could pull back into before potentially going against our trade to the upside. Right, so that has to do with this level, or these two levels in here. We can see that throughout the entirety of this overall pullback before the expansion again, this is the level in which we stopped. We made a lower low, lower high, lower low, lower high, and we failed to make a lower low. We then started our uptrend to the upside. So technically, this is that last selling volume, 9595. Okay, really close to 96 psychological level. So we failed to make a lower low, we pulled back, and again we failed to make a lower low again. So really, this is the start of our last selling volume, but this is our real last selling volume. So I ended up putting both of these levels. So as we can see, if we scroll all the way back over, we came into that level to the T essentially, and then broke this entire counter trend structure to the upside. So we got out of the market at the best price, and now we can look to get back in the correct direction. So we go back down to a lower time frame, and we can see now the shift in structure. We're making higher highs and higher lows, so we can be looking for buy opportunities. So if we go to the 1 hour time frame and look at what's going on in here, we will notice the reaction from that higher time frame objective. We move away from that very quickly. Okay, we end up pulling back, but we don't make a lower low. Instead, we make a higher high. So we can consider ourselves now bullish again. But what's going on in this region that makes it really interesting? Well, like I said before, there are two different kinds of head and shoulders. There's the one that both shoulders align with the neckline of the head, and there's also ones that look like this, right? Almost that, I don't even know what it would be called. It looks like someone's about to fight somebody. It looks like this is their wrists here and they're about to fight somebody. But anyways, the shoulder line doesn't come down to that exact headline right there. Okay, so that's exactly, we have type 1 and type 2. This is type 2. You can see that, right? Boom, 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 boom. That is type 2. So we have formed a higher, or a high. We have reacted from this level. Technically, we're still bearish because we're forming lower lows, lower highs, lower lows, lower highs. So we could expect a lower low. However, we do have to be careful because we actually came into a higher time frame demand. And that's exactly what happened. We stopped. We failed to make a lower low and made a higher high. So now we know we're bullish. But in here, we don't know we're bullish yet. So what do? We just have to wait. We can look for continuation short. But when I saw this is really what gets interesting. So what happened is we created a head and shoulders. Head and shoulders, and then price ran it. So step 1, find the head and shoulders. Step 2, wait for the breakout, enticing sellers below the neckline. And oftentimes, and not all the time, but oftentimes, when the breakout occurs, usually it either does one of two things. It either takes liquidity or mitigates something to the left. And in this case, it didn't mitigate something. It just took sell side liquidity. We can see that low and then the wick, that wick below it. So we snatched sell side liquidity. And then step number 3 is we wait for the reaction back in the correct direction and the break of structure. Lower low, lower high, lower low, higher high now. That's step 3. Step 4 is waiting for a pullback to enter. Okay, so in this case, we have to take a look at what's going on in here. So this was not one of the things that I sent to my VIP. I didn't see this at this current time. I saw another formation over to the right, which I'll show you in a minute. But where would we have looked to take this off of? Well, we can see that when we faked out, we pulled back and we repriced, meaning we failed to then make a lower low. And instead, we slightly had a retracement and then we broke structure back to the upside as expected to make that higher high. So this will turn in to that level of demand. It's that supply to demand flip. Now, where is supply flipping to demand? Where is the supply? Well, we can see in here that this right in here is our supply level. This is our last buying volume before the sell-off. So we push back up into supply. This creates this last buying volume. We fall back to the downside, make a lower low, lower high. We can see we tagged this supply zone, had the reaction, failed to make a lower low, higher high. So now this will flip to demand. Okay, so it didn't immediately come back down and mitigate, but that is exactly what you would look for. I would have placed my buy limit from that level every single day of the week. And in this case, it didn't quite come back down to mitigate. It actually continued higher, but we will see what happens next here. So as price is continuing, we can see on the higher time frame, on the 1 hour in this case, it just looks the prettiest, that it's again forming this head and shoulders. We have now failed to generate a lower low here, and we have now broken structure back to the upside, right, in the form of that break, and now we're bullish again. And now we're looking to attack this high. So now we know we're bullish after that break of structure, counter trend. Lower low, lower high, lower low, lower high, all that stuff, higher high. We've finally broken it, and we have failed to create a lower low compared to this low here because of the fact that we came into our higher time frame objective. All right, so you guys can kind of see how we're putting together the pieces here. All right, so in this case, we start to form another head and shoulders. Shoulder, head, shoulder. Now, they're not always going to be pretty. They're not always going to look like this. Sometimes they will be skewed, right? It will be a skewed head and shoulders. So we can literally clone this, put it essentially right where the shoulder line lines up. So the shoulder line here, we kind of retest where that head is, and then we kind of retrace back up, almost hit that left shoulder line, right? Sort of that skewed head and shoulders pattern, but the same concepts apply. What do? We identify the head and shoulders. We see the breakout, the manipulation, and then we push right back up in the right direction, taking retail traders stop losses. That's why we had the pullback here, because when we take retail trader stop losses, that's profit taking. Price then moves sell side a little bit before we can continue in the upside direction. So we broke the counter trend structure. Now we're waiting for pullbacks to get in. Now we can see, like I said before, usually, and not always, but usually when we have the breakout of the fake out of the head and shoulders, we usually see one of two things. Like I say, liquidity being run. Well, we always see liquidity being run in the form of the head and shoulders, right? But I mean to the left here. There's no liquidity that was run. It was more of the potential mitigation. Remember on the 15-minute time frame, we saw the repricing. So that's where we're looking to get in off of the fake out of this head and shoulders. Fake out, sell to buy, reprice, continue. So that's that demand. And now in the process of mitigating this demand level, we form another head and shoulders in which we fake out to again. We fake out from again, and we continue up. In this case, unfortunately, it didn't hit that level, but I would have placed my buy limit there. And well, unfortunately, it wouldn't have hit it. But it's okay. We let it go. We don't chase it. And we understand there will be more opportunities because now we faked out of this head and shoulders. Right? We had this sell to buy break of structure. So now we're looking for the pullback, mitigate to continue. It's really that simple. It's very systematic. If we understand the correct direction of trend, obviously we want to be looking for the fake outs of these head and shoulders to be in the opposite direction of trend, because we like to take liquidity in the opposite direction to then continue in the right direction, right? So if we know we're bullish, then we want to see head and shoulders be faked out to the downside and then continue with our bullish run. So we create a higher high, higher low, higher high. Now we just wait for the pullback back down into where we faked out from the head and shoulders. Now where do we look to get in? So now I want to pull my handy dandy bar replay tool here, and let's just keep scaling into this level. And I can see two levels. Well, I did my analysis before. This was actually sent out to our VIP community, but the first level was 97555. We can see that in the lower time frame, we had a little bit of a pullback, and then we had our last selling volume. So that sell to buy, that's what creates the demand here. However, where the initial liquidity was in flux, or volume was in flux to sweep the liquidity, was here. This was the start of the sell to buy. So I just kind of zoom back out because it was kind of already mitigated here. And it happened to be, I think, on the 2-hour time frame, there was just a little bit of an imbalance between that wick and this wick. So that really I wanted to get filled. So I had 9775 and then that 97555. Okay, so I'm gonna get out a bar replay again, and let's see exactly what happened. Well, when we make a higher high, what do we naturally expect? A higher low. See, we're including these institutional formations, the fake out of the head and shoulders, right, with market structure, imbalances, supply and demand, all of the other confluences that we need to fulfill our entire smart money concept strategy. Another thing I forgot to talk about is time and price. Time and price is so important because manipulation occurs around the specific times of the day, because liquidity is usually built up around Asian session. London session usually provides more of a fake out, and New York session really provides mitigations for continuations. So let's kind of apply that here really quickly to our first example. Right in here, this is all Asian session for me. This is all Asian session. Okay, we can see 13 o'clock, 14, 15, 16, 17, 20, 24, that's midnight, 1, 2 in the morning. So now this is really our Asian range right in here. So what happens is, even though this is a part of the overall head and shoulders, we can incorporate time and price into it. What happens during London session? We fake out of the Asian session highs, enticing buyers. Now, at the same time, we've enticed buyers above the Asian session high. We then run lower. But we already knew we were going to run lower because we wanted to sweep retail traders' positions, entice them to take shorts below the neckline, coming down and taking liquidity sell side right here below that swing low. So now we have it double time here. The retail head and shoulders fake out, and also the fake out to the upside above the Asian session high. This is London session, and now 8 o'clock in the morning, Eastern Standard Time. This is New York session open. We have the huge manipulation down. So we sweep retail trader stops that were buying in London session above the Asian range, and now we entice sellers below the neckline. Guess what price does? Immediately for the rest of the day, we push back and continue. So now the people who bought it during London session got the direction right, but didn't get the time right. They didn't get in at the right time because they were manipulated during the start of London session because of the Asian session range. So now the retail traders sell below the neckline here, and price then continues and they get stopped out. So it's all based upon manipulation. So if we can understand these formations, understand market structure, and understand time and price, we are going to be unstoppable, ladies and gentlemen. And all the VIP members that are currently a part of my community can attest to that. Go ask anyone else who is a part of our VIP community. They will tell you just how precise these levels can be if we just understand the basic fundamentals of trading. And that's why I say it does not have to be difficult. You know, when I first started trading, it was so difficult for me because I didn't know what to look for. I didn't have the right mentor when I first started. And I thought that the more complex it was, the better it was. You know, you don't need to make it very complex. It can be extremely easy if we are just patient, can manage our psychology, and can apply simple, basic concepts and be patient for when those concepts form to take advantage of them. All right, so we have to quit wasting our time. Like I highly, recommend, don't waste your time getting confused by information overload from all these gurus out there trying to make it sound more difficult than it is. It really does not have to be this difficult. I continue to trade like this time and time again, providing my exact entries in my VIP group, and our members are taking advantage of it every day, and it's so easy to understand. Yes, it takes time and practice to be able to apply it the correct way, but once you understand it, it becomes so much easier and stress-free, right? So continuing here, we just follow structure, and we're looking at time and price, manipulation, supply and demand, fake outs, just literally over the course of market structure. We're just looking for lower time frame entries. So again, we have the pullback, and look, these exact two regions of price, we mitigate from, to then go long again. In the process of pulling back, we actually form another kind of discrete head and shoulders. This is very discrete. We have a very small shoulder, a large head, and then another small shoulder again. And we fake out and then go long again, which creates the overall demand. So that's why I'm looking to buy if price gets back into where we broke out, 98,400. Our last selling volume to buy back up. We also have a lot of imbalance. That's how we can incorporate other confluences into this step-by-step retail head and shoulders fake out approach. Again, we make a higher high again. In the process of pulling back, what do we do again? Shoulder, head, shoulder, fake out, entice sellers, right back to the upside with the news event. And again, news is just the excuse to push price in the direction it was always meant to go. So the news could have, if it was bullish, the news could still push it short, but it's probably to mitigate something, take liquidity, and then move it in the overall direction. And Aiden, one of my co-founders, sent out a signal right here with a great 1 to 12 risk to reward that literally hit in a matter of hours. 1 to 12 could have passed a funding challenge in one trade. Because he understood that we're bullish, we had all the manipulation down here, we had all the confluences as I just mentioned, and we had another head and shoulders fake out to the downside into a level of demand, filling this imbalance right in here, having that sell to buy entry. News was just the catalyst to push price right back to the upside. If there was no news, price would have done this, just probably a lot slower, right? It just would have went like this, and then just went, right? So news is just used as the excuse to inject the volatility into the market. So boom, in this case, we sent out this trade. This was a 1 to 6.3. This is a 1 to 12.2. So what is that? Like 18.5%, something like that in 2 trades, literally in a matter of, since we got in right there, second position ended right there in a matter of 8 days. Less than 2 trading weeks, we hit 18.5%. And again, we're forming very similar formation. Shoulder, head, shoulder, kind of had a double shoulder, fake out to the downside, kind of come into this level of demand in here, and then we rally and we're breaking the right shoulder. So now we can probably say that we're going to continue to the upside here. So where do we look to pull back? And here is sort of a free signal for you all. Back down into previous supply, right? This is previous supply because lower low, lower high, lower low, lower high. This is supply in here that we came into. Lower low, this is supply in here that we came into. Had the reaction failed to make the lower low, and we made the higher high. So those 2 levels would be valid for me. Retest of that prior supply now demand. We can see the EMA confluence as well, back to the upside. Or if we have just a little bit of a teeny bit more of a pullback back down into this lower time frame demand, we can take that long there. I don't care if we lose this one and win this one. This is a 1 to 9. This is a 1 to 6. We lose this one, minus 1%, plus 9%. That's plus 8% in total. Aggregate positions would still be in profit. Okay, so that's Euro USD. I'm going to go over one on CADJPY that is very, very, very beautiful in the look of it. So we first have to do top-down analysis. What are we doing, and where are we heading? Well, are we buying or selling? What are we doing? Are we going long or short? You guys got it right. We're going long, right? Higher highs and higher lows. That's just clear market structure. And for the sake of time, I'm not going to go into objective, but the objective in this case is 117. It's an area of supply and imbalance way over to the left. Okay, so that's where we're looking to head. Now, let's scale into the lower time frames and look for these entries. So we create a higher high, we create a higher low. We create a higher high again, we create a higher low. We create a higher high again. This is not a break of structure. It's just merely a liquidity run. Right? We snagged liquidity and then we continue and make a higher high. Right? So we actually kind of form another head and shoulders fake out here. Shoulder, head, shoulder. It's a little unorthodox, a little bit, skewed in its look, but it's still the same concept. However, we don't break the neckline instantaneously. And sometimes we don't do that. That's another one I forgot to mention to you guys. So we have the different looks of the head and shoulders, right? We have this sell to buy. We also have this sell to buy. And we also have the head and shoulders that never breaks. And we end up coming back down later and taking it and then continuing. So those really are the 3 different head and shoulders that we will see. And as long as we're following trend, we already know there's liquidity resting below the neckline here, and retail's probably going to be selling below this head and shoulders. So there's liquidity resting below here, also in the form of people buying from this sort of trend line. So they're going to be selling below here. And as we can see, if I just extend this trend line over, you'll notice that we actually reacted again, which is why we had that bullish candle. Right, so now we know that buyers are entering into the market because of the reactions from the trend line. And when we know that, we can assume that price is going to run the stops of buyers, entice sellers below the neckline, and then take price long. Once we understand and see that we create a sell to buy, now we know what's going on and who's behind the movement. Institutions. So now we have a high probability chance that this will work out. We snag the lower low here, right? That sell side liquidity doesn't always happen. Usually I would expect some sort of demand to be held to go long, but in this case we took it. It doesn't happen too often when we're forming trend. Obviously, we don't like to see this. It's actually good if we do see it. That's a good because it's liquidity run, then we can pull back to buy it again. In some way it is a good thing to see. But normally, when you see a higher high, a higher low, and a higher high, you usually don't take out the previous swing point. You usually just create a demand, hit into that demand, and maintain your structure. Okay, so just wanted to point that out. It doesn't happen too often, but it does happen. Anyways, let's look at the counter trend now. Now I'm going to use my bar replay tool here to show you what's going on. So as we're coming down and pulling back and sweeping liquidity, we form a counter trend. Low, high, low, high, low, high, low, high, low, high. It's a pullback. That low candles, it's a one candle pullback, but it still is on the counter trend. So make a lower low. We bust right through that supply level. Bust right through it. And now when we pull back, it should turn into demand. So I extended that level all the way over to the left. And as we can see, that's exactly where we came into. But again, what is forming? The retail head and shoulders. Shoulder, head, shoulder. Fake out. Push back up. Break and retest. Remember, I said that was a possibility. So sellers below the neckline. If we extend this out, we can see that's exactly where we broke and retested. Break, retest, retail is going short. Nope, right back to the upside. Price goes long, hits their stops. Okay, so now we know the institutions are behind this move. Not only because we faked out of the head and shoulders and went long, but also because we swept liquidity, breaking through that supply level, and now we turned it demand, and that's exactly why we stopped there. There's a reason for every single movement in the market. All right, so now let's get out of bar replay and let's look at what our next step is in the strategy. So now that we know that we have identified the head and shoulders, we've waited for the breakout. Obviously, you have to trade within the trend, guys. I forgot to add that. So really, there's 5 steps. You have to identify the trend first. And so your head and shoulders, the manipulation has to go against the trend, right? Against the trend so that we can continue in the right direction, creating the sell to buy in this case. So trend, identify the head and shoulders, wait for the breakout, wait for the re-breakout, I guess, back up to the upside in the correct direction, taking the previous swing point, right? Because the counter trend is low, high, higher high, close below that or above that level. So now we just wait for the pullback into the prior, it once was supply, now demand or imbalance or repricing event or sponsor move, whatever it is, it's all going to be in this general location. So on the 1 hour time frame, as we just showed you, we created that sell to buy. And in the process of doing so, we kind of created many levels of demand. This sort of mitigated that demand. So this is an area of demand. However, the most important thing in this particular situation is the imbalance that formed. It's just straight buying volume all the way up in here, right? So there's no selling that was offered, because if there was selling offered, price would have pulled back to make the market efficient to then continue. But there was no selling that was offered. So we want to come back down and fill the imbalance. And where is this located? 104. 000, that's a psychological level. So that's where I'm going to be looking to buy this. And the great part about it is, guys, after we created a higher high, we're just following market structure. High, low, higher high. What do we expect? Higher low. So in the process of doing so, and what I meant by the best part about it is that it hasn't hit yet. So we can actually take this together. Higher high, we actually create buy side liquidity, relatively equal highs. We can see we never made this higher high. And just because it came below this swing point here doesn't make it bearish, because this is the low that made this higher high. So this is the entire range, right? So price could do this all it wants to. It's just an overall pullback into the level of interest that we're looking for to then go long again. Higher high, higher low, higher high. That's what we're looking for. So we form buy side liquidity, and it's really good that we do so, because that gives us the excuse to go and attack liquidity resting above these equal highs. Descending liquidity, relatively equal highs. Gives us that excuse to the institutions to go attack that liquidity, right? Because that's what the institutions are going to do. They attack liquidity. So we actually create equal lows here. We come back down, take those equal lows, and we're looking to buy at 104. Stops would go below where the sell to buy occurred here, where the breakout stopped. So it stopped right there. That's where our stop loss would be, right there. 141 pips. Guys, I know what you guys are thinking. Oh, it's 141 pips. This guy doesn't know what he's doing. CADJPY pumps out pips. This is a 4-hour time frame sort of entry here, right? So if you're looking at a 4-hour time frame entry, you're going to have a 4-hour time frame take profit. 117 is the overall take profit, which is an appropriate take profit for this particular trade because of the technicals that are presented on the higher time frames. This gives us a 1 to 9. So I don't care if you have a 2 pip stop loss and an 18 pip take profit, still a 1 to 9. This is a 141 pip stop loss and a 1300 pip take profit. This is a higher time frame trade. This will take a while, I understand. But what we can also do is take advantage of lower time frame breakouts. So we're coming into this 104 level. So we haven't quite hit it yet. We're actually forming relatively equal lows. So I would like to see, that sell to buy. Take liquidity, continue in the right direction. So we're actually sort of starting to accumulate in price here. So I want to see that last push into our level, break structure again, form that spring, meaning the counter trend hasn't been broken yet. We're still making lower lows, lower highs. I want to see it break. Now the structure has shifted on the lower time frame. We can look for pullbacks to continue long. Now, in that case, let's just say that we're entering, I don't know, right here. I'm just going to make this up. Well, then I'll clone this, and then I'll show you a new risk to reward that we could have. Let's just say it stops right here. Now that's 117 pips, a little bit better than 141. But now you go from a 1 to 9 to a 1 to 10.5. But, I mean, it could even be a lot better than that. It could even be, something like, let me just get rid of all this. It could even be something like this. Something like that. So the new risk to reward, because CADJPY does pump pips, guys. It just does. So it'd still be, it just depends on the setup that forms. It could be 100 pips, could be 50, could be 120. Who knows? But the risk to reward will still be there because, yes, if it pumps pips, meaning, yes, this is 141, but it's also going to pump pips to the upside like that as well, which creates the risk to reward, high risk to reward. So we don't have to worry about, the pips, because pips don't make you money, guys. It's percentage. That's what makes you money. So having an understanding, we will be looking to buy at 104, right? So keep track of that. If you want to take that alongside me, that's my trade. I already have a buy limit set. The next one I want to talk about is very similar to EURUSD, but it comes down to GBPUSD. We have so many different setups in here. We had 1, we had 2, we had 3 that didn't fully pull back, and then we had 4. But 3 of them are in profit, or 2 of them hit take profit. 1 of them we're still in, and the other one never hit yet because we didn't have the pullback. But anyways, I'll talk about these after I do the top down with it, and it's going to be very quick. Obviously, you guys can see we're in a bearish market. Okay, where is our overall objective? Well, as price was continuing to push down, if we can look higher time frame, 1985 lows. This is all-time lows, guys. When we were trading below this low here, and we kept going, what are we looking to attack? Where are the institutions taking price? Probably going to take out sell-side liquidity. They look to attack liquidity. They look to mitigate price. They look to make the market efficient. Those are really the 3 main objectives. Take the stop losses of retail traders to get better positions. Go and attack liquidity, sell and buy side liquidity, make the market efficient through imbalance fills, and continue, right? That's exactly what the market makers look to do. They're always hedging their positions because everything is fractal. Everything is happening on the lower time frames. That's why you can see these head and shoulder break fake outs on the lower time frames, but also you can see them on the higher time frame. So they're doing the same thing on each and every different time frame, meaning zoomed in and zoomed out versions of the exact same price, but then hedging themselves here and there. So they're always going to be making money in the long run. But in order to take sell side liquidity, if they're in buys in here, or excuse me, sells, let's just say there was liquidity right here and they sold it to buy. Well, yes, for years and years and years, they would be in drawdown on their sells, but they're always on the lower time frames. They're always hedging their positions or doing the same exact things, higher time frame or lower time frame than they're doing higher time frame. So they're making money all the way in here. And when finally price comes back down to mitigate or even to take liquidity, now they can get out of their positions and just repeat the process. So I know that was a lot of information, probably unnecessary, but you guys understand what I'm trying to say. So that was the overall goal. So when price is trading in this region right in here, we're looking for shorts. So let me show you what not to do. So we can't just expect head and shoulders fakeouts to play out all the time, meaning to anticipate their formation. We can see here, this is a fake out of this head and shoulders, right? However, we don't have the break of structure. This is a skewed head and shoulders, and we haven't hit the overall objective, which is down in here. So we would naturally expect price to continue to roll over. So in this case, if retail actually traded this as a head and shoulders, they probably would have won, or at least would have been in profit. But then if they kept holding and holding and holding, obviously this would be a higher time frame, shoulder, head, shoulder, fake out continuation. Exactly what we're seeing now, right? So if they had held, they would have lost, but short term they would be in profit. And that doesn't come around often, but we haven't hit the objective. So that's why price continues short here. But let me show you what not to do. When we have the shoulder, when we have the head, and then we have the right shoulder, when price pushes down and then starts to push back up, we can't just automatically anticipate that we're going to go long, that this is actually going to be a fake out of a head and shoulders. We have to clearly see the break of counter trend structure. Where is the counter trend? Low, high, low, high, low. If we get back above this level, then we would know that this is institutionally sponsored. And in this case, it didn't. It did not come above that high, and we just ended up continuing. So there's no trade involved, right? So there's no trade involved there, and we continue. So now prices finally came back down into that level of liquidity from 1985. We made all-time lows pretty much at 1.03585, something like that. Then we started to rally to the upside. So naturally, we're going to have some profit taking, liquidity runs, and we're going to have some relief. Okay, so price makes a high. We come back down, and we make a higher low. And in the process, we mitigate this high here. Now, why is this high important? Because this is a low, this is a high, this is the high that failed to generate the lower low, and we made the higher high. So that's exactly why we came back down to that level to mitigate it to the T, to the exact T, guys, to really almost to the pip. So if you don't believe smart money and institutional liquidity and formations and market structure works, well, then I really can't help you going forward because it's exactly how it works. So again, right in here, what is this? Retail head and shoulders. It's not, it's not always easy to identify, but it's usually always going to be there in some form. Shoulder, head, shoulder. Notice where the neckline or the shoulder line kind of lines up. It lines up in the same location usually, right? If we have a big shoulder, we're probably going to have a big right shoulder. If we have a very small left shoulder, we'll probably have a very small right shoulder. Well, we can still see it. The same concepts apply. The breakout or fake out, sell to buy, we've closed back above structure. Now we know the institutions are behind this. And what did I say at the beginning of the video? What is the purpose of a fake out? Not only to entice shorts below this level, but also obviously to take stops for anyone who's buying on this trend line, 1, 2, 3 touches here, but also to take liquidity or to mitigate. In this case, we mitigate this level right in here, as I just mentioned. That was the purpose of that move. So what do? Well, we break the counter trend structure to the upside. Now we're waiting for a pullback. Where do we look to pull back into? Well, let's look at the counter trend. Guys, you can see how it's repetitive. I'm saying the same things over and over and over again. That's why trading does not have to be hard. It really doesn't have to be, and I can't stress it enough. So let's look at the counter trend here. Lower low, lower high. Lower low, lower high. Supply. Come into that level. Lower low, lower high. supply, come into that level. Lower low, lower high, supply, come into that level. Failed to make a lower low. We didn't make a lower low here. We made a higher high. So where was that last selling volume? Right here. We need to come back down and mitigate that. So that's how we can determine our entry points with these head and shoulder breakouts, or fakeouts, excuse me. And that's exactly why we came back down in here. But before we mitigate price, or we mitigate this region, what do we form again? Same deal. Shoulder, head, shoulder, sell to buy, reprice, continue. This is our new demand in here, right? So it's the same exact stuff. And what are we also forming? 1, 2, 3 touches. People are selling, so we know we're going to go long, because if they're selling off the trend line, there's liquidity. Boom. All right. Hopefully this is starting to make sense to you all. So we can see where was the liquidity purged. Starting right here, sell to buy, and I love this. I love doji candles following the sell to buy reprice, meaning I love to see when we fake out and we move back to the upside, I like to see the doji candle be the candle that we fail to make a lower low with, and we end up making a higher high. I like it to be a doji because it's that indecision, right? It's that playing off of supply in here that fails to make a lower low and the higher high. So I like that. And again, if we go down, this is just insane. I didn't even notice, right? Well, because usually, when I'm doing this, I'll sort of kind of plan out what I'm going to talk about, obviously, because I want to show you guys, what certain things mean. But in this case, I totally forgot about this. This was sort of a head and shoulders. We can see the shoulder a little bit here, head, and then the shoulder again. And that's the exact example I gave before when price didn't immediately take the liquidity and entice sellers, and instead we stopped and just went high. But doesn't matter, we still will come back down and take that liquidity and also entice sellers below that head and shoulders. We still haven't forgot about it. But in that process, this is the overall demand. Really, this is the demand here if I push this up, and we can clearly see that. Why? Lower low, lower high, supply, lower low, lower high, reaction, failed, higher high, breaking counter trend. That's our demand. Supply, flip to demand. So this is how we can incorporate all of our smart money confluences while we're still looking at these head and shoulder fakeouts. That's why we have to have the holistic perspective. So where is that demand lining up with? 1.12, psychological level. So let's go back out to the higher time frame, and what do? Higher high, higher low, higher high. What do we look for? Higher low for a higher high, just market structure. So we look to mitigate this region of demand, 1.12, and that's exactly what we did. Exactly what we did here. And now we start to form higher highs and higher lows again. And Aiden, just like on EURUSD, had that level of demand in here that we played off of. Stops were below the low, targets for 1.17. So we had a 1 to 5.8, and on this one we had a 1 to 3.5. So it's still a beautiful couple of trades. So we can just see how the head and shoulders faked out, which caused the liquidity run, enticing sellers. And now we have the reaction, the retracement or the repricing, and the continuation, break of counter trend, wait for the higher high to be formed, pull back into this level. Now, would I have taken it long from here if price pulled back here? Yes, because we closed above counter trend, which it did here. And we also formed sell side liquidity because we had 1 touch, 2 touch, 3 touch, also an additional confluence because if price came back down into here, 1 would have been the mitigation, but 2 would have had the excuse to go run buy side liquidity above this retail trend line. Okay, so beautiful reaction, 1 to 3.5, still a really good risk to reward there. So in this case, this was 3.5, this was 5.8. So what is that, like 9.2, 9.3% in like 2 trades? Still not bad at all. So this is how we can introduce head and shoulder fakeouts into our overall smart money concepts strategy, our holistic perspective. But we can see just how easy it is. Really, there's 5 steps. Look for the overall trend. Look for the overall trend, higher highs, higher lows. Look for the head and shoulders, head and shoulders. Look for the breakout below the neckline. Look for the reversal in BUS, reversal, break of structure. Wait for the pullback to enter. If we could have pulled back here, we just didn't. We stopped, went higher first, but we wait for the pullback, Same spot to enter. Higher high, higher low, higher high, higher low, looking for a higher high. Exactly what we're having. We keep going, and none of these are head and shoulders related. This is sort of a head and shoulders. We can see in here. It's kind of a skewed one, but we never got the fake out first and then the buy up. That would have been nice to see. But we didn't do that. But we had other confluences to take it long from this level of demand in here. Doesn't have anything to do with head and shoulders fake outs, but thought I'd just show you that we entered this past week. So looking for 1 to 6.3 here, and we're about at the current time about 4.1% in profit. All right, so about 4.1%, which is really not that bad at all. Still pretty good. It's about a half of a profit from challenge. All right, guys, so I hope you were able to kind of see how we look to incorporate these head and shoulder fake outs into our overall smart money concept strategy, into these institutional concepts to formulate our entire strategy here. But it really is that simple, guys. We don't need to complicate it. As long as we can manage our emotions, be patient and wait for these setups to form, we can be very successful, even just following that simple 5-step plan on head and shoulders fake outs. So guys, if you are finding yourself, looking for clear-cut answers to your problems, let's just have a chat. I guarantee you I've had the same problems before. Everyone starts somewhere. You're human. I'm human. We're all the same. I had to start somewhere. I was hopping around from strategy to strategy. I had no clue what institutional liquidity was. I had no clue what sell to buys were, imbalances, and even head and shoulder fake outs. I had no idea how to trade it, what to look for, whatever. So I'm pretty sure your problems were my problems were your problems. We all go through the same thing. So, if this sort of stuff resonates with you, if you want a simplistic approach to your trading that can really produce insane risk rewards, as I've gone over, just with those 3 examples, CADJ, GU, and EU, in this case, 3.5, this is 5.83 on EURUSD, this is 6.3, and this is 12.1, insane risk rewards. Set up a free consultation on my website, www.aerialfxtrading.com. Book a call. It's completely free. I want to see, what your goals are in trading, how we can best assist you, if we're the right fit for each other, and giving you an exact plan in which you can utilize starting today that you can take advantage of to really start escalating your trading. If you want to learn exactly how I trade step by step to make it as simplistic and streamlined as possible, working with me one-on-one, book that free call. We'll see if we're the right fit for each other, to see if you're qualified to join our program. And I would love to be able to mentor you to help you catch these trades day in and day out that we're sending to our VIP members every single day. So guys, hopefully you guys took some value from this video. Drop a like, subscribe, comment, whatever, to show love and support to these videos here. If you want to see more of these videos, please feel free to reach out to me with suggestions. I'll be happy to see the feedback that comes in and take appropriate action from there. So guys, enjoy your holiday season, and we will talk to you all later. Take care.